And while my next guest expects a quarter-point cut next week, he's not ruling out a bigger one, especially if the tone within the Fed and the markets hold around 50-50 in the days before the decision. Krishna Guha is here now. He's vice chairman of Evercore ISI. Krishna, it's great to see you. So a last-minute call, you think?
So, look, I suspect that Chair Powell is very conflicted coming into this meeting. My hunch is that his own instincts may go more in the direction of the bigger 50 basis point cut, though there seems to be quite a lot of inertia on the wider committee. And, more likely than not, still, I think it goes to that so-called dovish 25, so 25, but a promise to step up at future meetings if needed. But I do not think this is a lock, and I don't think we should read those comments from Williams and Waller on Friday as communicating a decision that's more or less been made. I suspect that that decision, that call from Powell, still lies ahead.
I've always wondered when you think they make these decisions, because on the one hand, they're real people who want to respond to the latest information. On the other hand, they have big staffs. They have to make presentations to fellow board members. It's, like preparing for any big meeting. You usually do it in advance.
For sure. And look, this, in my experience, including having worked for the Fed, is that these decisions are almost never really made on the day. They would tend to take a harder shape really this week ahead of the decision next week. So it's really, it's game time now. I think certainly, the general bias on the committee has been, may well still remain, to follow a principle of gradualism to begin with. But Powell promised us at Jackson Hole a reaction function that was forward-leaning, where they would go out to be fairly aggressive in managing downside risks. It seems to me on the merits that it really is a no-brainer at this point. I don't think any Fed official would be particularly troubled if they went to bed tonight, woke up tomorrow morning, and found out that the Fed funds rate was 4.5%. Not 5.5%. And the argument for getting on with it, I think, is quite compelling. You don't need to believe the labor market is about to crack right now. I don't think it is, to think that it would be prudent to take out a bit of insurance at this point against those more adverse labor market outcomes. And the cost of doing that in terms of inflation is really pretty limited at this point.
How persuasive are those arguing that declining bond yields and, swiftly dropping commodity prices are pressuring the Fed to go bigger so as not to fall behind?
Well, those arguments can be made in both directions, right? You certainly get people making the argument you just presented. You also get some folks on the more hawkish side saying, well, what's the rush, right? The market's been doing a lot of work for us. Maybe those, 10-year yields and so on might have, even fallen a bit more than we think is necessary to shore up the soft landing. My own view is that the market has shown the Fed the way, and that the Fed ought to be a little bit careful to make sure that it's loosely validating the basic beliefs that are embedded in those market prices. That doesn't mean outsourcing your decisions to the market. The Fed would never do that. But I don't think you should be too dismissive if you're on the Fed about what you're seeing in the market pointing you towards what may be required to lock this soft landing, which the Fed clearly wants to do.
Absolutely. And your comments make me think that tomorrow's CPI is kind of a live number, so to speak, that really could influence decision making one way or the other. Have to leave it there, Krishna.